Welcome, everyone. Thank you so much for joining us for another expert interview. My guest today is August Biniaz, and I am so excited to have August here. For those of you who joined me earlier in the year for my masterclass, you'll know that August is an expert in development. And he and I were having a great chat a couple of months ago, and he was telling me about this brand new asset class that he is getting into. So I'm really excited to have August come and sort of do an in-depth dive into the latest and greatest, newest thing that is close to his heart. I'll do a quick intro for you to August so you know who he is and where he's coming from, and then he's going to dive right in. So August is a developer, general partner, and real estate private equity thought leader. That's a pretty big title. He's got 15 years of experience in real estate. He's also the co-founder of CPI Capital, where he acts as the COO, managing the day-to-day operations of the firm. He also works with operating partners across the US and investor partners across the US and Canada. August was instrumental in the closing of over $208 million of multifamily assets since inception, which is pretty awesome. That's a lot of multifamilies. So August has a passion for sharing his knowledge and helping others reach financial freedom. He enables investor partners to earn substantial returns by investing in multifamily and BTR, which is buy to rent, and SFR properties in the hottest US markets. He educates his investor partners about real estate private equity through the CPI Academy platform, YouTube show, webinars, meetup groups, Real Estate Weekly LinkedIn newsletter, and he also does some one-on-one coaching. August, thank you so much for joining us today to share your passion in real estate with us.
Absolute pleasure and honor to be here with you, Elizabeth. Really, thank you. I hope to be able to add value to your audience. And yeah, a true pleasure to be here.
Oh, thank you so much. Well, I'm excited to learn more because we just had sort of a brief conversation. Tell us a little bit um, about sort of this asset class. How do we know what it is? What's the definition, and how do we start looking for it?
Absolutely. But allow me to tell you a little bit about myself and our focus here at our investment firm, CPI Capital. We are a multifamily focused investment firm, apartment investing focused firm. So I will be talking about a different asset class, which is a deviation from our focus, from our mandate. So I don't have a dog in the race. This is not a case where it's an asset class that we've been involved for a long time and I'm pitching it. This is an asset class that I've had my eye on now for the last few years, and I've seen the growth, and I've seen a lot of institutional investments in this asset class that kind of piqued my interest, and eventually an opportunity came across our desk that we couldn't walk away from, and we have actually started investing in this asset classes early on. In this stage right now, we have just gone into PSA with the seller for this project. But yeah, I'll be touching on this asset class. This asset class is so new. I'm excited to kind of be talking about it, that if you do some research online, you will see a lot of the content and information is very new. It is so new that a name really hasn't been cemented yet for it. So, it mostly is known as BTR SFR, or build to rent single family rental. People call it build for rent, build to rent, single family rental communities, single family rental portfolios. So a really title like multifamily, industrial, office space, hospitality, as such title hasn't really been cemented for it. But currently, most industry specialists call it BTR SFR, or build to rent single family rental. And what it really is a community or a portfolio of single family homes which are operated and managed just like multifamily. And the differentiating factor between portfolio and community is a community is in one bundle in one area, and a portfolio in most times is scattered. It both could be a business model utilized by investors. They could buy a scattered group of homes and operate them and manage them just like they would a multifamily, to create efficiency and reduce cost of management. But they could also, of course, do it as one community. Another really great thing about this asset class is different junctures where investors could get involved. So an investment firm like us could partner with a builder and actually build single family homes for the purpose of renting, and then start renting them out, and at some point, depending on the business plan, exit this project. They could buy an already built a housing community from a developer, or they could buy an existing one and one that has been operating for a while. So there's really different junctures you could get involved in this business, in this asset class. In our case, in the deal that we're doing currently in Tucson, we are going into contract with the developer, locking in our price today at a low market, but we're purchasing the homes when the developer has built them and delivered it to us at certificate of occupancy. So as you can see, this asset class, it could be many different business models could be utilized within this asset class, depending on at one juncture the investor group is looking to enter the asset class. But that's a bit of a background about it. I can get more into it. I do have a presentation to also provide, but let me know if you have any questions, and where would you like me to go? I didn't want to keep talking.
Yeah, no, I appreciate that. So help us understand before you jump into your slides. I know a lot of people, myself included, I'm not a big believer in buying single family homes for a long-term hold. Like I'd buy a single family home if I was doing a rent to own, or I'd buy a single family home if I wanted to do like a flip. But I wouldn't buy a single family home with the intention of just renting it out. So what is different about this particular strategy that makes buying single family homes make sense versus buying a multi-unit building?
Yeah, great question. And your background really comes from being here in Canada, where the rent to value ratios are much lower than in the US. The yields are much higher. So the rent strategy actually makes sense because the yields are so high. When these single family BTR SFR single family portfolios or communities, their yields that they produce relative to where the debt markets are so high that they're even greater than what multifamily produces, apartment buildings. So yeah, when you're comparing BTR SFR, built to rent single family, to a single family strategy, there is much greater yield when it comes to a portfolio or a community of single family homes. And also the approach is, I'll go over it in one of my slides, but the approach in the financing world and the investment world is single family is the approach that is utilized to purchase and invest in single family is the comparable approach. Where if you have a home on the same, if the two of us have a home, similar homes on the same street, and my home brings in twice as much as rent as yours does, I can't ask for twice as much for the price. We're probably going to end up the same price. In multifamily, that's not the case. Multifamily is assessed by the income approach. If you have the two same buildings on the same street, one of them has twice as much as NOI as the other, the value is considerably higher. So single family rental communities are assessed by the income approach, not the comparable approach in a single family investment strategy.
Awesome. Okay, that's great to know. All right, well, I'm going to turn it over to you and let you do your thing, and then I'll just take notes. And when I have questions at the end, then I'll be sure to ask.
Absolutely. I'll share my screen. Perfect. Great. So yeah, I'm here today to talk to you guys about this very interesting asset class, built to rent, single family rental, BTR SFR. I've said it a few times today also. And really, of where did this asset class come from, where it's going, how can investors be able to invest in these types of investments, and a lot of other important points about this asset class. So I'll touch on the history of BTR. Where did the asset class, where did the strategy of buying swaths of single family homes and managing them and operating them like multifamily, when did this really start? And all of this really started after GFC, the great financial crisis that happened in the US. It's one of the most catastrophic parts of the economy, the history of the US, and housing gets affected. The homes are being foreclosed on because of the mortgage situation, and now homes are being foreclosed on and are being sold on pennies on the dollar. Large institutions like Blackstone's and others, right, large private equity firms see an opportunity to purchase single family homes, pennies on a dollar, knowing that the market will come back, knowing that the US economy is very strong and it will eventually come back after this black swan event. So they start buying single family homes. They buy it as portfolios, they buy it as communities. They're buying thousands and thousands of single family homes. Again, the plan is to exit this at some point in the future. But while they've bought these homes, they think about, hey, we could rent this out and have some form of a rental income coming in. So they start renting them out. And what they figure out is that single family as a portfolio, as a community, as a bunch of single family homes, it actually behaves like multifamily, is managed the same way. They could use the same property management groups. They could use the same strategies to manage, and if there's a value add component, they could use the same strategies for single families as a portfolio. So it was basically the impetus for a lot of capital coming into the space and for large institutions to keep investing and growing in this space. So that's really the start. And ever since then, I'll have another slide here shortly. I can show you that many other groups are getting into the space and into single family rental space. So I'll go over and show a couple of your videos for the first few minutes of it, and then we'll get into the next slide.
Buying a home is still not getting easier or cheaper. According to a report from CoreLogic, home prices in April were up more than 20% from a year ago. Lots of people are priced out, so some are looking to rent a house instead, and developers are ready. There are now brand new suburban communities designed just for renters. CNBC's Diana Olick has the story of how some big landlords are now also becoming big builders.
It's moving day for Stephanie and Jake Murphy. These millennials just sold their home in pricey California and moved here to Mooresville, just outside Charlotte, North Carolina.
We didn't have any family in California. We have a 1-year-old daughter.
In our Priced Out of Jackson series, Action News Jax investigates what you face looking for affordable or even available housing.
Yes, the housing shortage continues. There's a growing option offering families all the perks of a brand new home without the long-term commitment. Imagine entire communities of single-family homes being built to rent. And that's exactly what we're starting to see more of here in Jacksonville. Right now, a quarter of all single-family homes in Duval County are owned by real estate investment companies. That's according to the Duval County property appraiser, Jerry Holland. Last month, Holland told Action News Jax he expects the trend to continue.
As that number.
And you can see, if you do a research online on YouTube or on Google and just type in build to rent, you'll see so much content. And these are all in the last 60 days. And this is very recent videos that are available on the internet. So there's definitely a lot of interest and a lot of coverage of this particular asset class taking place right now. So we're going to go back here and we're going to kind of, John Burns did a great investigation into how much capital is actually coming into this space. And you can see these, all these large firms, and you have JP Morgan, Blackstone, Graystar, all these large firms coming into the space, and you can see the number of how much they've invested into the space. I mean, 375 million. You have other groups that have invested billions of dollars. You have here, this group here, $1 billion they've invested, 2.5 billion. You have Rockpoint that have invested into the BTR space. So there's a lot of institutional capital coming into the space and investing into build to rent, single family rental. And this is what I was discussing with you earlier on. So the difference between single family and multifamily. I mean, I'm a multifamily evangelist, right? I love the multifamily, the way it's operated and managed. Multifamily properties are much more efficient when it comes to the way they're managed. The property managers usually charge you a percentage of the total rents collected, which is industry is around 3%. So it's much more efficient than single family. Same thing with any kind of renovations or value add. The economy of scale is much better as well. So they're really institutionally managed multifamily. Built to rent single family is, again, the same concept. As long as you have a group of single family homes, you manage them just like a multifamily. So you have a property manager who looks after it for you, either internally with your firm or as a third party. So much more efficient, and the same systems that are in place for multifamily could be used for BTR, SFR. Look at some more benefits of build to rent single family rentals is that they actually they yield around 20 to 25% higher rents than multifamily communities do. The type of tenant demographic that rent single family homes in these communities are stickier than their apartment rental counterparts because they just stay longer. They just stay longer than apartment renters do. Other important points is that the income for the tenants who rent in single family rental communities is higher income. Again, it's maintenance free living. There's more privacy, improved level of security. And as far as privacy, really, COVID is what happened was COVID is expedited the process for people wanting to have more privacy, wanting to have a backyard and what have you. So you see a lot of different demographics coming into the space. You got baby boomers, millennials, Gen X and other demographics generations coming into this space. Again, this slide goes over, again, it's all over the news in Wall Street Journal talking about this particular asset class. And there's another trend that's happening in this asset class as well is renters by choice, people who could easily afford to buy a home but rather rent. And that's because they're not sure about their employment. They're not sure if they want to live in that city. And Americans are much more mobile than Canadians are. I talked to a lot of American counterparts, and at one time they're living in Arizona, and then the next little while they're living in Florida. So they're much more mobile. And what better than a single family home in a all rental community for you and your family to really live in. Empty nesters, baby boomers, they're looking, if they sold their home and they want to live maintenance free, they can live in these communities without having to cut the grass or maintain. Everything is maintained for them. So that's another group that this is really great for. So we're going to talk about, obviously we're in an increasing interest rate environment currently, so it's important to touch on that as well. But I will touch on that in a moment here. Occupancies are much higher for build to rent single family rental communities compared to multifamily. And again, we touched on retention earlier on. The collections are also higher. So this slide really talks about that. Again, we went over the different demographics that live in these types of homes and the need really for housing that exists in the US. And this really helps with the housing that exists. Using my common sense, if you had a choice of living in an apartment, as long as you're paying a similar rent in an apartment with somebody living above you, below you, next to you, or living in a home, the choice is really, it's a no-brainer really. And then the pandemic, I was touching on that as well, is now you have a lot of people working from home, and when you're stuck in an apartment, it might not be very conducive to your situation. A lot of people rather live in a single family home setting. We know that the mortgage, we're in an increasing interest rate environment. The mortgage rates are increasing, and it's harder for people to afford to buy a home. Again, renting is a better option where it costs less to rent than debt service a single family home currently in most areas in the US. And again, this proves pre-pandemic, there were 6% of people working from home. Post-pandemic is at 15%. So again, it's that flight to quality for tenants. Rather than living in apartments, they rather live in single family homes, and so on and so forth. Mortgage rates, we touched on this earlier on. Again, the mortgage rates are going up. At some point we're hoping for it to taper off, but again, is making home ownership more difficult. As you can see here, rents have gone up 17% compared to 63% in mortgage payments. So again, this flight to quality, this idea of renting, and then if you have a choice between an apartment or a single family home, this is a great option for people to rent. This talks about the buyer, as far as the buying power of investors because of the mortgage rates. I will not touch on this lots because we already went over it. Benefits of investors. I'll touch on this as well through the syndication model. So how can investors get involved in BTR SFR? We talked about that these are institutional assets. These are in the tens of millions of dollars. So this is not a situation where one person can go and buy a single family home and rent it. This is, a group of single family homes, a portfolio, a community. The asset that we're currently working on is 71 single family homes. We're purchasing it over $20 million. So it's going to be difficult for an investor to invest into, acquire that large of a property. But the syndication model really allows for investors to get involved. There are syndication groups out there like us, and what they do is when they have a deal as such, they syndicate it. And what that means is they created a structure called a limited partnership. And a limited partnership is really comprised of the general partner and the limited partners who are investors. And each investor can invest a very low point of entry, $50,000 or $100,000, and they receive limited partnership units in an entity that owns the asset. And that allows people, investors to get benefit from this growing and great asset class that's here to stay and here to grow. There's tax advantages as well. Unlike REITs, syndicated investments have tax advantages for investors, and so on and so forth. I can touch on this a bit more. I'll let you ask some questions about it, so I'll just briefly go over some of these items. General partner, limited partner, I discussed this already here. This is a project here that we're working on. So as you can see, 71 single family homes that we're purchasing as a community. They're all individually titled, individually metered. So it makes it much more efficient when it comes to management and allows us to have an exit strategy to sell them as a portfolio or sell them as individually single family homes. But the strategy is to sell them as a community because they're worth much more as a community than a single family home. But at least we have that option. This is just a picture of us here with our investors, our limited partners who invested in our deals in the past. And this is a way to get in touch with us, but I'm sure you can see that in the show notes at some point. So I'll let you ask some questions and we can dive deeper into this interesting asset class.
Sure. Awesome. Thank you so much, August. Much appreciated.
Of course.
Okay, so I have a bunch of questions for you. So my first one is, you mentioned at the end that the titles of these properties were held, their individual titles held by a corporation, right? So normally in Canada, if you buy two properties that are beside each other with the same owner, then the titles merge. Is that something that's different in the US, or is that something that is just somehow different in this circumstance?
So when we syndicate a deal, when we purchase this community, if it's a single family community of homes or a multifamily apartment building or an apartment community, we create a limited partnership. It's the limited partnership that owns the asset. It's that entity. Right. So it behaves somewhat like a corporation, but rather than shares, you're receiving limited partnership units. So even though each home is individually titled, the entity owns all the homes. So it doesn't really make a difference when it comes to each individual homes, but go ahead.
So it's I guess it's more almost like a condo corporation then, like the way that a condo building has all these individual pieces. So like if you owned a house and I owned a house on the same street beside each other, and I bought that piece of property and it's in the same name as my house is in, then those two titles would merge and that would become one title then. So I'm guessing there's something about it being in the US, or there's something about the way that you've structured it that's different so that doesn't happen.
It's very similar to a condo. Imagine if we were going into a building, a condominium, and we're buying every single condo. They're individually titled, but it's the entity that owns all the titles within the same entity.
Gotcha. So that clarifies. Okay, thank you. So tell me a little bit about, you mentioned some of these really large companies that are buying into these asset classes. Are they doing things similar to REITs? Like, are they just coming in with like boatloads of cash and they're not really worried about, financing rates and all those kinds of things? Are they just buying with cash, or are there literally companies coming in, they're doing the financing and everything else that a smaller investor would?
So commercial real estate over the past 20 years has beat the S&P 500 by huge margins, all different asset classes within the commercial space. And that's really because the superpower that exists within real estate is leverage. So leverage is used to buy assets. So I've never really seen any institution or individual investor really not utilizing leverage, no matter where the markets are, where the interest rates are at. So leverage is always used in these investments, no matter if it's a REIT, a fund, or a syndication. Leverage is always used. Obviously, as far as when you're entering the market and when you're exiting the market, where the interest rates are at, and as far as if you're sitting on the sidelines with dry powder ready to enter the market, depends on where the interest rates are heading. So those do factor in, but overall speaking, because of leverage, even if the rates are high, still the yields are there enough to warrant an investment. And a lot of these larger institutions, they're a business plan, the term is between 5 and 10 years. So they usually hold the asset for around 10 years. So you'll probably go through at least a couple of real estate cycles within that 10 years.
Got you. Absolutely. Absolutely. And can you just explain for those people who are newer to real estate, what is the sort of formula or what are you using to calculate yield? What are those numbers that you're putting in?
Yeah, great question. It's really the cap rate. The way that yields are calculated in the commercial real estate space is something called a cap rate. So cap rate is basically the unlevered returns on a property. So if you were to buy the property, so for example, the property we're buying, let's just hypothetically say we're buying it for $20 million. If we would have bought it cash without any leverage, what would be our annual profits on that? So if the profits were 4%, on our $20 million, that gives us a 4% cap rate. So that kind of gauges where you're at. Does this economically make sense? And then you compare your cap rate to your interest rate, and that kind of gives you your margins on the properties, on the asset that you're acquiring.
Gotcha. And the reason why this works so much better in the US than Canada is because the acquisition price is so much less versus the rents that are being charged, right?
Yeah, so it's not so much the acquisition, but is the rent to value ratios. So we're buying these homes at $300,000 a piece, and we're renting them out at $2,000. If you compare that to buying a home in Vancouver and Toronto, for let's say $3 million, you might be able to rent it for $5,000, and that rent to value ratio is at 20 basis points, where we're at 70 basis points. So the yields are much higher. So the cap rates are essentially higher in the US, in certain regions, obviously not in California and New York, than they are here in Canada.
Gotcha. So tell me about if you're looking for markets where this strategy would work, what are some of the key fundamentals that you'd be looking for in markets? I mean, I'm assuming the Residential Tenancy Act and the rules governing landlords, that would be part of it. What else would you look for?
Absolutely. We look for regions that are landlord friendly, business friendly. That's when it comes to our ability to be able to do our value add strategy, if that's the strategy we're doing, or increase rents as the market, the rents increase within the market. So we're not handicapped by restrictions where we can increase rents. So definitely we look for landlord friendly states. We also look for other, very important key metrics, which are certain growth metrics. So we look for population growth, income growth, rent growth, and these are really the growths that we look for in the regions. And within the U.S., you really have a interstate migration happening. People are moving from California and New York into these lower cost of living states. And we're taking advantage of that interstate migration happening and the demand that's there for rental, particularly with these migrant demographic.
Perfect. That's awesome. Now, obviously, with brand new builds, the repairs and maintenance doesn't need to be as high as it would be if you were buying an 80-year-old house and renting it out. What kind of numbers could people sort of anticipate? I mean, I would imagine, most of the damage in the first kind of 20 years would potentially come from tenant damages versus, anything due to age or wearing out.
Absolutely. No, great question. So deferred maintenance and cost of management and cost of renovations. Now, renovations could be part of an investment strategy. For example, the value add strategy that is utilized in multifamily, where a lot of investment groups come in, buy a multifamily building, go in and do renovations to the units that are vacant, and then demand higher rents for those units, increasing the NOI, and then doing the same process, rinse and repeat, and increasing the NOI and exiting the asset at some point. So that's a strategy within itself, but obviously older properties have higher cost of maintenance, higher cost of management, and there's unknowns behind walls when you go to try to do renovations. With BTR SFR particularly, not only is much lower cost maintenance, not only homes are much more efficient when it comes to insulation and other ways they're built in modern ways of building, you also have warranties from the developer that you're purchasing from. So for example, our Tucson project, the 71 homes, there is a 10-year warranty on the homes. Obviously, there's different types of warranties that are there for the first 2 years, the first 5, and the first 10, but there's still warranties from the developer, which they're obligated to come and fix, aside from any damages caused by tenants and what have you.
Gotcha. And so these are not duplexes. These are not like up downs or anything like that. This is one family living in each home.
Exactly. One family living in each home. They're all, independent structures, so they're not connected to each other. Now, build to rent, that strategy, again, I said that there's a lot of confusing words here. We're focusing today on BTR SFR, build to rent single family rental. But build to rent can also be utilized for other asset classes like multifamily or even townhomes. And I'm sure you're aware of groups here in Canada utilizing the CMHC loans to put down 5%, get 95% LTV, and build apartment buildings and rent them out. And the rental yield, it gives them a surplus over their CMHC loan. That's the strategy utilized here. But as far as our discussion today, these are single family homes that are fully detached. They give the independence to the tenants. In some cases, they also have a backyard, the side yards, and in some cases, they also have amenities. But that really depends on the demographic that you're, either building or purchasing a BTR SFR project. For example, Phoenix. In Phoenix, a lot of BTR SFR communities have a lot of amenities. They have pools, they have, other recreational facilities. They have a leasing office. In our Tucson project, because of the demographic, we didn't feel like it warranted having amenities for that project. So it's really deal dependent. In some areas, it makes sense to have amenities. In other areas, it doesn't really make sense to have them.
Yeah. And I would guess, for seniors or something like that, you might want amenities, whereas, if it's younger millennials and that kind of stuff, you wouldn't necessarily want that too. So it depends on your tenants for sure.
Great point. Yeah. For example, for our deal that we're doing, and this is a strategy that's utilized by a lot of larger investors as well, we're building single story, a lot of single story. We have also 2-story. 40% of our homes are double story, but we also have 60% of them that are 1-story, and that is mainly to cater to that demographic of baby boomers. So they don't want to go up and down stairs. They have one level, and maintenance free living. So it really works out great for that demographic.
That's awesome. Can you just give us a little insight into what's going on in the US market versus what's going on in the Canadian market right now? Why investing in the US might be appealing for Canadians?
Yeah, no, great question. So the US, when it comes to the debt market, I mean, the debt market really affects investments and the yields. So, and the debt markets really mimic each other. Overall, the US, the economy is 10x the economy of Canada. Their investment logic is a lot different than Canadians. They have a lot of other strategies. For example, a 1031 exchange would allow someone to defer their taxes pretty much forever, and it creates more commerce and business where they're obligated, if they sold a property, to buy another piece of real estate property. So it creates a lot of business. And then there's also other great tax advantages and strategies investing as a LP, as a passive investor into syndications or funds. Not so much into REITs, because REITs are structured differently. They don't offer the same tax benefits as funds and syndications do. But yeah, on the tax side, there are a lot of benefits in the US. The yield it's also much greater. And we talked about rent to value ratios. The population, I mean, is 10x the population of Canada almost. You have the interstate migration. So we just, as investment groups, we really follow the migration trends that exist through different creative ways. And a lot of data out there. So yeah, as far as investing in the U.S., it's much more superior to Canada. Also, you're cash flowing in most investments in the U.S. Again, in certain areas, it'd be very difficult. In most cases, you're in negative cash flows in the larger cities here in Canada, whereas in the U.S., if you're investing in the Sun Belt, in most cases, you're cash flowing. In some areas, they even have the 1% rule, which your 1 month's rent equals 1% of the asset value. I mean, that's a tremendous amount, right? We don't have those types of yields here in Canada. The other thing is also, in my opinion, and I don't mean to talk negatively, Americans are much more entrepreneurial than their Canadian counterparts. They're much more inclined to do, to do business, to venture into businesses they have, and we've experienced that because we service both Canadian investors and U.S. investors, retail investors. Is a much harder sell when you're talking to Canadian investors. They're hyper cautious. They're very conservative. U.S. investors again are more entrepreneurial. They're more inclined to invest in these types of investments that we structure and we put together.
Awesome. Oh, that's great. It's interesting that you've noticed that difference. I guess it goes back to, Canadians being the polite and the, somewhat restrained and, those kinds of things, like despite the fact that they're our neighbors just south, that we really are quite different from them.
Yes, exactly. They're cowboys,
Yeah.
right? They're
Yeah.
Americans.
Um, so if you were looking at a project like this, what would your minimum be that you would be willing to accept in terms of a yield? Like, are you always aiming for, a minimum of 30% on one of these deals, or what should someone expect or be looking for in one of these types of deals?
So the yields are really achieved in two different ways. They're achieved through the cash flow and through the capital gains, to the profits upon sale, upon exit or refinance. So when you're looking at cash flow, we're looking at between 6 and 8% annual cash flow to the investors net of fees. That in the interest rate environment is, the debt environment we're currently in, it is suppressing those returns. But those are the numbers we look at when we want to get into a project as such. And then the kind of annualized returns, which includes the cash flow and the back end profits, we're looking at in the 20 to 25% annualized returns. Those are the numbers that we go into deals and we look at. But again, the market is changing a bit. We are somewhat in a recession phase of the real estate cycle currently. Investors need to be understanding that there might be reduction in cash flows, or there might be less cash flows early on when they're getting into a project. So, but overall, that's 6 to 8% on the cash flow and 20% annualized returns, and then a high teens in the IRR. And the IRR really calculates, it's basically the velocity of returns to investors. IRR is a metric used by a lot of investors to know right away if this investment makes sense for them, because it calculates the time that time value of money, really, of when they're getting their returns. Because you could invest $100 with two different investment groups and both of them double your money in 5 years, but one of them gives you your $100 profit in 5 years and the other starts giving you $20 per year. And the one that gives you $20 per year that investment has a higher IRR than the investment that gives you your profits at the time of exit. So some investors look for that because they could reinvest the returns that they receive into a different investment, or they could do other things with it.
Yeah, love that. That was awesome. Thank you so much, August. You're such a wealth of information. Like, this is just, every time I talk to you, I learn more. What are kind of your thoughts? And I always love to ask investors, what are your thoughts right now in terms of when the recovery is going to start? Do you think that the US is going to start to recover first? Do you think that we have a rough, 5 years ahead of us? What are you sort of looking at, or what are your predictions for how we should prepare.
Great question. Well, I definitely have a dog in the race when it comes to real estate and what have you. So,
Yeah.
I'm always bullish on real estate. Our projects are 5 to 7 years, so we're looking to get through any type of downturns in the market and survive it and be stronger on the other side. But when you're looking at the situation we're really in currently globally, this is a synthetic recession that we're in, and you can see that because the definition of a recession is 2 negative growth quarters. We have 2 negative growth quarters, but there's still officially we're not in a recession, and that's because the job markets are so strong, and the job markets are so strong because you have the baby boomers who are retiring. You don't have the new generation taking over their jobs, so the retention is very high for jobs, and the economy is doing great, but the inflation is there, unfortunately, and inflation is there is because the Fed and also a lot of other central banks around the world started printing money to pay people so they don't have to go to work and spread COVID, and that stimulated the economy, and a lot of people had extra cash and they start spending it, and now they've got used to this concept of spending, and the spending is still very high, and that's what created inflation. Now, unfortunately, when it comes to the U.S. and to the Federal Reserve really has 2 jobs: controlling inflation and unemployment, and they really got one lever that they can pull when it comes to when it comes to controlling inflation, and that's interest rates. They only have one hammer, and so what they do is they increase rates and they watch the market to see where it's at. So now they've increased interest rates considerably, 75 basis points just not too long ago. But at some point, my prediction is that the job market is very strong. That a lot of the reports that we see with CPI, they haven't really caught up yet. So I don't think the CPI reports are truly accurate. I think the increased interest rates are having an effect already. Jerome Powell is talking about possibly looking for 1 million jobs lost for that to bring the inflation down. I think there is a possibility for there to be a chance for soft landing, as they call it, where they're at. So I'm looking forward to look at the next CPI report here. But I think overall, the U.S. economy is very strong. The U.S. dollar is very strong, as you can see, its difference with the British pound and other currencies around the world. Overall, people, America has a great brand. People want to live there. People want to move there. People want to do business there. As you can see with, for example, we're having our conversation today about U.S. and U.S. real estate. I think overall, we are in a situation where the interest rate had to be risen for it to control the market a bit. I think eventually at some soon point here, and I'm being recorded, so I should at some point this is going to be rewatched. So I believe that we are going to go into, I think we're already in some form of a recession, and think this increasing in interest rates will cool off the markets a bit. I think people will tighten their wallets a bit more. If there's people losing their jobs, that will tighten the markets a bit more. I think we should be coming out of this cycle probably within 1.5 years, and we should be that's when I think the interest rates should be either tapering off or even being reduced at that point, which will stimulate the real estate market. So I really think that the next 1.5 years is where the difficult times are, and there's always opportunities that exist in a recession phase of the real estate cycle. So that's my prediction of where we're going to be: 1.5 years of hard times, and then we're going to be coming into sunshine and rainbows on the other side.
Awesome. Well, I really hope that you're absolutely correct, August. That would be fantastic. Most of us as investors, we can protect our assets right now. We can get through the next 12 to 18 months, but it would be great to start to see the market recover at that point for sure.
Absolutely. Absolutely.
Thank you so much for your time today. Thank you for sharing your knowledge. It's always appreciated, and we wish you all the best. Have a great fall.
Of course, you too. Thank you for having me.
Thanks, August. Take care.